Today is Friday, January 6th, and this is your daily mortgage rate update to keep you in tune with the ever-changing mortgage interest rates. So, where are mortgage interest rates today? Well, let's quickly break it down and then run a quick live scenario. But first, let's review the technicals. Today, the 10-year yield is at 3.67, which is about 5 basis points lower than yesterday. And we like this, okay? We'll take it. The 30-year 5.5% bond is at 100.86, which is about 45 basis points higher than yesterday, and we really like this. Remember, the lower the 10-year yield and the higher the 30-year bond, the better it is for mortgage interest rates. And again, these two figures are amongst the best indicators of where mortgage interest rates are heading. Translation, what does this all mean and what is causing the bond market to shift? Well, it all goes back to inflation versus deflation. And today's non-farm payroll report had an interesting mix. Look at this headline on Yahoo Finance. December jobs report. Payrolls rise by 223,000. Unemployment rate falls to 3.5%, which that 3.5% is really low. Now, let's break down the details. I want to break down the non-farm payrolls, those numbers, the unemployment rate, and the average hourly earnings, because all of that mix is very interesting. So, new jobs, 223,000 were added. It was expected to be 202, so that's plus 21,000. That is very good for an economy. So new jobs, job creation is there, and it's great. This is also very inflationary, and the bond market does not like that. Remember, inflation is the worst enemy of mortgage interest rates. And this unemployment rate being at 3.5%, it was expected to be at 3.7. That's also very inflationary. And if we go back to, even 2010, just take a look at this, 9.8% in 2010. And over the years, it went down to, again, 3.5, 3.6. And we all know what happened here in March of 2020, and it spiked up to 14.7%, which was not very good. That was horrible. And it quickly has been settling right back down to that 3.53, under 4%, since, 2000, about a year ago. So this is all inflationary, but let's go back to the average hourly earnings. Month over month, we were expected, or this report was expected to have wages increase by 0.4%, but they didn't. They increased by 0.3%. That increase came in lower than expected, meaning that wages are not increasing as expected, and this is disinflationary, and the bond market likes it, so we like it. So let's price out a live loan to see the effect of all these market changes on the actual mortgage interest rates, because we know that things don't always line up. So this is a VA loan program scenario, but if you need a quote for a conventional, jumbo, or FHA, just DM me. I'd be happy to help. Remember, these figures are all accurate, live, and to the minute, so they're subject to change with the market. So this is a $500,000 VA loan purchase with 0 down or 100% LTV. Occupancy is owner occupied, and it is a single family residence with a 740 FICO score. So let's see what we have. Looks like we have we do have a 6.125% with an APR of 6.186. So that means there's about a $130 fee to obtain this interest rate. So the payment for this is going to be $3,621, and that includes the principal, interest, taxes, and insurance. So let me know if you would like a personalized quote like this for yourself, or visit me at prequalifywithluis.com to learn more about the benefits of home ownership. And as always, I'm not going to suggest to lock or not lock today, because every single situation is different. So that is all I have on this video, and what an amazing first week of the year. Hope you have a wonderful day, and I will talk to all of you on Monday. All right, bye now.